What if I told you that a financial alarm bell has begun ringing in a market most people have barely noticed? It's not Bitcoin. It's not the stock market. It's not housing. Something far more fundamental is shifting beneath the surface. Something that could ripple through industries, technologies, and portfolios in ways few anticipated. A global silver panic is starting, and most people have no idea why. But if you understand the forces that have been quietly building beneath the headlines, you will begin to see that this moment is not random. It is the result of patterns that were forming for years. Patterns tied to demand, supply, global stockpiles, and the evolving role of silver in a rapidly changing world. For centuries, silver played a role in human history that was both practical and symbolic. Long before digital currencies or modern finance, silver served as money. Empires built their economies on it. Wealth was stored in silver coinage. Trade routes moved it across continents. But as the world industrialized, silver's monetary role faded. Paper money, central banking, and electronic finance replaced it. Silver seemed to recede into the background, becoming a commodity rather than a currency, priced and traded like any other raw material. Yet silver never lost its industrial significance. Its physical properties, high electrical conductivity, reflectivity, durability, and antimicrobial surface, made it indispensable to modern technologies. It found its way into electronics, medical equipment, photovoltaic cells and solar panels, advanced industrial applications, and countless high-precision instruments. As early as the late 20th century, industrial demand began growing quietly, year after year, without fanfare. Photographic film once dominated silver use. But as photography went digital, new technologies absorbed silver's capacity, often in ways that were less visible and more profound. By the time solar energy began its exponential rise, silver had already been woven into the fabric of industrial demand. Solar panels rely on silver because it is unmatched in conductivity and reliability for photovoltaic cells. Every megawatt of solar capacity demands thousands of ounces of silver. And as the global push for renewable energy accelerated, driven by climate goals, economic incentives, and technological progress, the demand curve for silver began rising sharply. The world was installing more solar capacity in a single year than it had in entire decades before. This is where the first twist begins. Silver stopped being a minor industrial metal. It became a critical strategic material. Yet the financial markets, accustomed to silver's slow rhythm and often overshadowed by the allure of other investments, barely noticed. Pricing models continued to treat silver like a secondary commodity, influenced largely by paper contracts, speculative positions, and short-term trading flows. But behind the scenes, real physical demand was growing, quietly and persistently. The origins of the tension we are witnessing today can be traced to a fundamental imbalance between physical demand and physical supply. For decades, mining output had grown at a modest pace. Silver, unlike iron ore or copper, is often produced as a byproduct of mining for other metals such as lead, zinc, and gold. This means that even when prices surge, silver supply cannot simply expand overnight. Mining new deposits takes years, significant capital, and often faces environmental and regulatory challenges. At the same time, much of the silver embedded in industrial products, especially in electronics and renewable infrastructure, does not return to the supply chain quickly. Recycling helps, but it cannot keep up with the scale of consumption. Even as demand steadily rose, many analysts continued to assume that stockpiles, inventories, and recycled supply would act as buffers. In major financial centers, warehouses held millions of ounces of silver, and these inventories were visible, reported, and assumed to be part of global supply. But the deeper reality was that these stockpiles were not being replenished at the same rate they were being drawn down. The world was consuming more silver than it was producing or recycling, and the difference was being met by drawing down inventories that had been accumulated over decades. At first, this depletion was subtle. Year-end reports showed declining warehouse inventories, but the changes were small enough to be dismissed as normal market fluctuation. Analysts who focused on short-term pricing cycles saw these movements as noise, not structural signals. But as the years passed, the pattern became unmistakable. Inventories were not just declining, they were collapsing, and the pace of depletion began to outstrip even the most conservative forecasts. The rise of silver demand intersected with changing global financial conditions in ways that few anticipated. When demand is driven by real industrial use, price movements tend to reflect fundamental scarcity rather than investor sentiment alone. Silver's dual role, as both an industrial requirement and a perceived safe haven asset, created a situation where both sides of the market began pulling in the same direction. Industrial buyers began securing long-term supply contracts. Investors, noticing the declining inventories and rising demand, entered markets with increased urgency. And forensic data from vault receipts, exchange stocks, and refined metal flows started pointing to the same uncomfortable truth. The world was running out of easily accessible silver. The breaking point arrived when multiple major warehouses, those associated with global exchanges and institutional inventories, reported stock levels at multi-year lows. This was not a seasonal fluctuation. This was a structural decline. And the numbers did not lie. Analysts began comparing current drawdowns with historical data, and the contrast was stark. Silver inventories had never fallen this rapidly without a significant supply shock or unprecedented demand growth. And here, both forces were present. Demand was rising faster than supply, and inventories were depleting faster than ever before. As that realization spread among industry insiders and institutional investors, behavior changed. What had once been a predictable market with a slow turnover of physical metal became unpredictable. Buyers, who had previously relied on tactile trade flows, no longer waited for paper contracts or futures positions. They began demanding physical delivery. Companies that integrated silver into their manufacturing processes started securing multi-year supply agreements. And major financial institutions, once comfortable with paper derivatives and fractional claims on metal, began rebalancing their portfolios to reflect the reality of physical scarcity. This is the moment when the global silver panic began. Not as a moment of irrational fear, but as a rational response to real constraints. Silver was no longer a metal one could assume would always be available in necessary quantities. Its physical scarcity, combined with accelerating industrial demand, created a market dynamic that traditional models had never fully priced in. The fallout from this shift has been multi-layered. On the supply side, miners have struggled to expand production fast enough to cover the gap. Regulatory hurdles, exploration costs, and environmental concerns make rapid mine development difficult. Even new discoveries take years to become productive. On the demand side, industrial growth continues unabated. Clean energy infrastructure, electronics, medical technologies, and advanced manufacturing all depend on silver's unique properties. These are not optional uses that industries can delay without consequence. They are embedded in long-term strategic deployments. Efforts to fix the imbalance through recycling or alternative materials have provided some relief, but not nearly enough. Silver's role in photovoltaic technology, for example, is integral. There's currently no economically viable alternative that matches its efficiency at the same cost. Similarly, in high-end electronics and medical applications, substitutes do not perform at the same level. These realities mean that consumption will continue to rise even as supply struggles to catch up. Modern parallels further illuminate the gravity of this moment. Throughout history, markets have entered panic phases, not because of speculation alone, but because fundamental supply constraints collided with rapidly rising demand. Oil crises in the 20th century, rare earth shortages in the early 21st century, and even timber or semiconductor shortages all reflect the same pattern. When a foundational material becomes constrained, the effects ripple outward across industries' prices and global economic expectations. Today, data from financial markets, industry reports, and physical inventories paint a picture of rising pressure on silver. Prices have responded, and while pricing alone does not tell the full story, the trends indicate that markets are adjusting to reality rather than speculation. When institutional buyers, industrial consumers, and everyday investors all push in the same direction, supply constraints become visible not just in charts, but in physical delivery times, premiums on real metal, and expanding lead times in contracts. From all of this, three clear takeaways emerge. The first is that silver's role in the modern economy is far more strategic than most people have understood. It is not simply another commodity, it is a foundational material for technologies that define our current and future infrastructure. The second is that supply constraints and inventory depletion are not temporary trends. They reflect structural imbalances that have been forming for years and are now reaching critical visibility. The third is that markets often adjust sharply once physical realities overcome financial assumptions. When scarcity is real, prices become secondary to the availability of the material itself. This leads to an important warning. When foundational materials enter a period of physical scarcity, the effects are rarely confined to one market. They spread across industries, affect supply chains, and ultimately influence broader economic trends. Awareness, early understanding, and thoughtful preparation become essential. Ignoring these forces can leave industries and investors unprepared for rapid adjustments that feel sudden only because the underlying dynamics were not widely understood. Silver's current trajectory, rising demand, collapsing inventories, and structural scarcity, is a signal that markets are no longer in a period of comfortable abundance. They are in a period of transition, one that will likely reshape how investors, industries, and nations think about essential materials. Understanding the forces at play allows individuals and organizations to make informed decisions rather than reactive ones. If this explanation has helped bring clarity to a complex and evolving situation, sharing this video can help others understand the deeper forces at work. Financial literacy grows not from short-term headlines, but from sustained insight into the systems that shape real value. As the global market continues to navigate this new landscape, Staying informed and thoughtful is the best way to engage with the forces shaping the world's future.